मेरा लैपटॉप 4.5 के बाद अवेलेबल नहीं है, उसको मिल छोड़ दो, कल ही करना है।
Hello students, how are you?
Okay. मैं तो कनेक्ट ही नहीं करता सपोर्ट से।
आप भाई वो सवाल करते नहीं पूछिए।
मैं बोलूँगा आपको टाइम पता है।
Hello students, how are you? I hope you're all fine and in best of your health. Today is day number 4 of financial management practice to pass sessions, and our today's topic include a bit of financing and cost of capital, and then we'll be doing some work on risk management. So these will be our main topics today, which will be starting in a few minutes time. And before we start the cost of capital area today, I want to discuss about the cost and the capital structure. So students, the first important thing is that when we obtain financing, I'm discussing a concept and then we'll move on to the question. So the first important thing which we need to know in financing, in raising finance, is that we have two main types of capital. One is the debt capital and the other one is the equity capital, right? So the debt capital, mostly they are either loan notes or bonds or redeemable preference shares, right? This type of capital is cheaper compared to the equity capital, like ordinary shares. So if the business issues shares and raises capital, it is much more expensive compared to the cost of compared to raising finances from debt. So cost of debt is lower than the cost of equity. Now what happens then, that once you want to invest money in your new proposal or a proposed investment, and you want to carry or calculate an NPV. So in order to calculate a net present value, you have to first calculate a discount rate, a cost of capital, using which you will be calculating the present values. So to calculate a present value, the discount rate that you need is an average of the cost of debt and the cost of equity. And as I said, cost of debt is much lower than the cost of equity. Now why it is so? So one of the reasons behind that the cost of equity is higher is that the equity is riskier to invest for the investors. So if the investors invest into equity, they are taking a bigger risk. Ultimately, a bigger risk would attract or should attract a bigger return. So they expect a higher return on equity by taking a bigger risk. Therefore, if the business refuses to pay them that much of return, the investors won't pay them the money. So it is very important that you cater the needs of the investors. So as the investors' requirements are high for a risky investment, the business will have to pay them high. And ultimately in debt, in case of loans, the investor, if they give you a loan, they know that how much interest they will receive, when they will receive, and when the principal will be repaid, and what is the security. And if the company fails to pay the loan, then they can get their amount returned by selling off the security, by realizing the security. So they are safe enough. They know when they will receive the money, and in absence of a repayment, they can redeem the securities. But in case of equity, it is very risky because it is dependent on profits, and no business can say that our profits will remain smooth. Usually the profits of the businesses fluctuate. Ultimately, the dividends will also fluctuate, and the conditions in the market fluctuate. economic conditions. So the business sales will be fluctuating. Ultimately, it affects the profits. So the investors do not know that what profits or what dividends they will receive every year, or what will be the movement on the share prices. So that's why, as they are uncertain as to what the movement will be and when they will receive cash, they are facing a higher risk, and therefore they ask for a higher return. So equity is expensive and debt is cheaper. This was a main discussion. Now, if you include a bigger portion of equity in your finances, so obviously equity is expensive, more of the portion or more of the weight will be of equity, so your cost of capital will be higher. And if you obtain more funds from that, then what happens that in your this is known as a capital structure, that what percentage of your total funds is from equity and what percentage is from loans. So if more of the portions come from loan and debt capital, it is cheaper capital, so the business will be having a lower weighted average cost of capital, right? So this is important. Secondly, there is one more point regarding the cost of debt, that as we saw in past, that if you obtain loans are bearing interest. So if you pay interest to the investors, the tax authorities allow you to deduct the interest from your taxable income. And when you deduct the interest from your taxable income goes down and you save tax. So in this way, the cost of debt helps you saving in some tax also. So if the cost of debt is 10%, which you are paying in cash to the investors, and 30% is the tax rate, your net cost of debt will be 7%, because 30% you will save from tax out of the 10% that you pay. So it will be 7%, which will be your actual net cost of borrowings. But in dividends, you can't deduct dividend from your taxable income, so you can't save tax. So this is known as a tax shield, which is available in cost of debt, and it is not available in cost of equity. So this also helps you out in reducing the cost of debt. So what happens, that Modigliani and Miller says that if a company is geared and it obtains loans compared to the equity, if it keeps borrowing more and more and more, so what happens, that the company's weighted average cost of capital comes down, it goes down, it reduces. So if you have more loans than equity in your capital, in your financing, your weighted average cost of capital will remain lower. This is what Modigliani and Miller says in his theory. But he also adds that if you borrow too much, then the bankruptcy risk increases. In that case, the cost of capital and the cost of debt may rise up. So it shouldn't be, the company shouldn't be borrowing too much. It should be a balance. There should be a balance, proportion of debt at which the weighted average cost of capital is lower, so that the NPVs of the project can be better. So it is very important that when you are obtaining finance, you neither add too much of cost of debt, which is cheaper, and nor you add too much of cost of equity, which is expensive, right? So there should be a reasonable combination of them, so that you get a good or a lower weighted average cost of capital, and your NPVs of the projects will get better if you have a lower cost of capital, a reasonable cost of capital. So okay, now let's start with the cost of capital work. This was basically a concept on cost of equity and cost of debt, and the impact of the proportion of cost of equity and cost of debt on the weighted average cost of capital. So now we begin with doing the question AMH. Our next question is AMH. So students, this question is available in the day 3 handout. So today, I repeat, we are going to do some work on cost of capital, and also obviously financing portion will be covered, as I explained right now, the financing portion which is affecting the cost of capital. So these two topics will be covered, and then the remaining portion in the end will be on the risk management work. So students, you can go through question number 5, AMH, and I remind you students that I have placed the day 2 workings worksheet on the group, so you can use the workings and the things from there. I've also included some theoretical portions which I discussed in the yesterday's class in that working, and I've also placed the questions which I gave you on assignment. I placed the answers of those questions in that sheet. So it's a complete sheet now, the day 2 working, and now we'll complete today's day 3 worksheet, and then move on to the day 4 worksheet, risk management. I'm also fine, thank you. Yeah, you have the actual answer sheet on the group. Okay, students, let's start with AMH. So please go through it. I'm giving you some time to read it. I'll be scrolling the question down so that you can read the full of the question. Welcome and good afternoon to all of you who are people who are joining right now. Welcome to all of you again to this workshop. I hope today also we do some good work, some good practice work today, and some good tips also are shared with you. Yes, good afternoon to everybody. Thanks for the greetings. Okay, participants, let's start. Let me show you first a few things. Let me point out some important areas from this question. Look, the question's requirement is calculate the market value weighted average cost of capital. So by this, they mean to say you have to calculate a WACC, weighted average cost of capital. So you have to calculate a cost of capital, the cost of funding, the cost of the fund raised by the business through various sources of finance. We have to calculate the average of it. So from which sources first find out that the business has gathered the funds. So the business gathers funds from 4 sources in this question, and those four sources are: 1, the 4% preference shares. 1, they are being carried at in the statement of financial position at 3 million, right? And it is of the face value of it is $1 million. Then 7% bonds that are redeemable. This is also 3 million. And the long-term bank loan. Bank loan is not marketable security. Otherwise, preference shares, bonds, and equity shares, the ordinary shares. This is the 4th one, the 4th source of finance. So there are 4 sources of finance. 1 is equity, and 3 of them are debt capital. So first we will have to calculate the market values of these, because in order to calculate the average, we don't have to calculate a simple average. We have to calculate the weighted average, right? Weighted average means, okay, the cost shall be considered according to the value of the finance that has been raised. If you have raised more finance from a particular item, for example, loan or loan notes or bank loan, you have to consider more cost of it. If you have raised less finance, you have to consider less cost of it. So you have to weight it according to the value of it. Okay, so that's why it is known as weighted average cost of capital. We'll be writing an answer also on it. Secondly, the cost of ordinary shares. First we'll calculate the market values, and then we will be calculating the cost of each item. These 4 items cost we have to calculate. So we will mark it as we will take cost of equity as KE. We will take cost of preference shares as KP, and we will take cost of bonds as KB, and we will take cost of long-term bank loan as KBL. So these will be our abbreviations. Okay. Secondly, for cost of equity, we will be using the dividend growth model. I'll be sharing the formulas with you in a few minutes. We will be using DGM. DGM is the dividend growth model. Now, how did I know that I have to use the dividend growth model? This can be known from the data in the question. If you can see, they have given you dividends in the question. So from these dividends, you come to know that dividend growth model will be used. We have to study this. The latest dividend is 36.3, which is given over here. I've recently marked. So this is the latest dividend in the year 2012. So through this, we will judge that the dividends from 30.9 keep rising and reaches 36.3. So what should be the rate? We will use a formula to calculate this. So we will do the working in two steps. First, we will calculate the market values of all the sources of finance, 4 of them, and then we will calculate the cost of each item. And then in the last step, we will be calculating the weighted average cost of capital. Okay. So students, let's start with this question. I'm starting to answer this question, and I'll be calculating the market values first. Okay, so value of various finances. First of all, market value of equity. According to the question, if you note that the equity capital is 4,000 as per statement of financial position, but one of the share is just of 50 cents. So there should be 2 cents per dollar. So the number of equity shares are 8,000 multiplied by the market price, which is given 4.7. Always use ex-dividend market price. When calculating market value, they have told you ex-dividend market price. So sometimes they give you cum dividend market price, CUM, cum dividend market price. So if you deduct the latest dividend, which is the dividend which has been recently paid, from that cum dividend market price, you arrive at the ex-dividend market price, right? So if you have been given, I repeat, cum dividend market price, multiply it with, deduct the latest dividend which has been recently paid from that cum dividend market price in order to arrive at the ex-dividend market price. So it is ex-dividend is the market price which prevails in the market immediately after the payment of the latest dividend. Okay, so 8,000 into the market price, which is 4.7. This gives you 37,600, the market value of equity. Then we come on to the market value of preference shares. The market value of preference shares, each preference shares is worth $1 face value. So there are 3,000 preference shares as per the statement of financial position, and each preference share is of 40 cents in the market as per question. So this has been given down after the statement of financial position. In the question, you can note after the dividends that they have given the market price of the preference shares. So this makes 1,200. Okay, after market value of preference shares, we calculate market value of the bonds. So for the bonds, in the statement of financial position, they have given you 3,000, right? But each bond is of $100. So by dividing with $100 face value, you get the number of bonds. So multiply the number of bonds, which are 3000 divided by 100 makes 30 bonds, by the market price. So each bond's market price is given in the question, and that is $104.5. So this gives you the market price for these bonds. So this is 3135, and then market value of bank loans, the fourth item. Now bank loan is not traded on the market. It is known as a term loan. It is not a marketable security. So you won't be having a separate market value of bank loan. The market value of the bond will be equal to the face value of the bank loan. So it remains at 1000. Now this gives you the total value of all the capital, all the four types of capital involved in the business by AMH company. Okay, so that's the total value. Okay. Now moving on to the cost of finances. So cost of finances will include cost of equity, then cost of preference shares, then cost of bonds, and then cost of bank loans. So these four costs are now to be calculated. Now let me give you the formula for these calculations. Okay, so we'll be using these formulae for calculating these costs. So first of all, we'll be calculating cost of equity. For cost of equity calculation, we are using dividend growth model. So the formula that will be used are as follows. First, we have to calculate the growth rate, and then we will put in the growth rate into the dividend growth model, the cost of equity formula. So it is at two places we have to put the growth rate, right? And then the dividend, this is the current dividend, this year's dividend, multiplied by 1 plus growth rate, and this is the ex dividend price, which is $4.7 right now. So it will be placed over here. Now in order to know the growth rate, we need these two items, the latest dividend and the earliest dividend, and this is the number of years. Number of years will always be a n-1 rule. We always use n-1 rule. So if we have 4 dividends, we will use 3 years. We will not use 4. Now 4 dividends means that the change has taken place in 3 years, right? It is like this. Why not 4 years? Why n is not 4? We will take it as 3. The reason behind is that this dividend is the first year. This is the base year. This is the first year. This is the base year, 30.9. Now you move on to 32.2 in 1 year time. Then you move on to 33.6 in the second year's time. And then you move on to the 35 in third year's time. And in the fourth year, you move on to 36.3. This is in the fourth year. So the total number of dividends are 5. But the n will be equal to 5 minus 1 equals to 4, because we need growth. So the growth has taken from 30.9 to 36.3, the dividends, right? So dividends have grown from 30.9 to 36.3 in not 5 years. There are 5 dividends, but the increase has taken place in 4 years. So we'll be taking 4. So let's solve this growth rate first, and then move on to the dividend growth model cost of equity formula. Okay. So the growth rate G is equal to the latest dividend, which is 36.3, divided by the earliest dividend, which is 30.9. Put a power 1 divided by 4 on it. And deduct 1 from it. And then multiply, after solving all of this, multiply it by 100 to arrive at the growth rate. So the growth rate makes 4.1%. It is 4.1%, or simply 4.1% is out of 100. 0.041 out of 1. So we have to use this 0.041. The growth rate has to be used, growth percentage will not be used. And then we move on to the cost of equity formula. So the cost of equity is the latest dividend is 36.3. We'll multiply it by 1 plus 0.041 and divide it by the market price, which is 470 cents. Actually 36.3 dividend is in cents, so I have to take the market price also in cents. So I take the market price in cents, and then the growth rate is 0.041. Now this gives me the cost of capital, which is 12.1% approximately. So this gives me 12.1%. So I have found the first cost of finance, cost of equity, which is 12.1%. So one by one we are finding out the cost of financing. Now the next one is cost of preference shares. Students, please keep solving with me so that you also people keep practicing with me. So for cost of preference shares, remember that preference shares are irredeemable, right? And there are no taxes on it. So straight away the formula will be cost of preference shares equals to dividend, which is paid on 1 share, divided by the market value, or the total dividend divided by the market value of all shares, right? So the dividend being paid on preference shares is 10%. How did I know about 10%? Because the preference shares, as per statement of financial position, are 4% preference shares. Sorry, 4% preference shares. So dividend paid will be 4%. So take 4% of the face value. So the dividend is going to be, dividend on preference shares is going to be 4% of the face value. Dividend is always calculated on the face value. So $1 is the face value. Multiply it by 4%. So you arrive at the dividend which will be paid on the preference shares, and this will be equal to 0.04. Now the market value of preference shares, as we calculated above, was in total, but one preference shares market value is $0.4 or 40 cents. The market value is 40 cents. The 40 cents means $0.4. So I've taken dividend also in dollars. So if I have to take both of the items in the same currency, So the cost of preference shares makes 0.04 divided by 0.4. So both in the same units in dollars, and then the cost of preference shares becomes 10%. So I found another one. So the cost of preference shares is 10%. Now, so remember, if whenever the capital is irredeemable, okay, whenever the capital is irredeemable, you can safely divide the return on the capital with the market value. So dividend divided by the market value. But if it's a loan, in case of loan, deduct the tax effect. Means interest into 1 minus t divided by market value. So the tax effect will be taken. Okay, Temur, you want to know the market value of loan. So the market value of loan is like this. In the balance sheet, the amount appearing is 3 million, right? So I took that amount first, 3 million. And the face value of a loan is 100. So I divided it by 100. So it made 30. So there are total 30 bonds. And I multiplied it with the market price, which is 104.5. So this is how I got this market value, 3135. Okay, Temur, is it clear? We have used the same formula in every cases. For market value, what I have done, I have multiplied the quantity of each item with the market price. So it's a simple rule of calculating market value. Formula is same for all items. So this is the formula. The value of finances equals to, the formula is quantity of the shares or bonds multiplied by the price per bond or share. This is the formula. So in order to, I did knew the market price of one bond, but I didn't knew the number of bonds. That's why I divided it with 100. Okay. Okay. Sorry. If actually you're talking about loan. See, there is the market value of loan and the book value will be same, because the loan is not being traded in the market. Temur, loan is not being traded in the market, so there won't be any market value. So it's same as face value. So I've taken straight away the same figure over here. So it is known as a term loan. Term loans do not have a market value as they are not being traded in the market. Okay, now cost of bonds. Before going on to cost of bonds, cost of bond will be internal rate of return. If the bond is redeemable in some years, suppose, then you have to calculate internal rate of return, right? For cost of equity, you will be using either cost of debt or cost of equity. And for irredeemable items, you will directly divide it by the market value. Yes, okay. Pavishne, let me tell you about the cum dividend. The student is asking me about cum dividend. See, cum dividend market price of a share means that in some days a dividend is being payable. So the market prices would have been increased by the dividend amount. So in calculating market price, we use a stable amount. So this market price increase due to the announcement of dividend is temporary. Once the dividend are paid in cash to the investors, the price will come back down, and that price is known as ex-dividend price. So suppose in the question you are being given cum dividend price, means the latest announced dividend are included in the price, so you have to remove it so that you get a stable price, which is ex-dividend price. Ex-dividend price will not change in the shorter term. So its cum dividend price is just for a few days it has increased, because after payment of dividend it will come back down. Is it clear now? So always use ex-dividend price. So deduct the latest dividend from cum dividend price to arrive at the ex-dividend price. Okay, now cost of the bond. If the bonds are redeemable, like in 5 years time, 4 years time, so in that case you have to calculate the IRR of the bond. So we will calculate the IRR of the bonds. If irredeemable, the interest into 1 minus tax divided by market value, like preference shares. Like in preferences, I divided the preference dividend by the market value. So in case of irredeemable, you directly divide the return with the market value. But in case of a bond which is irredeemable, you will deduct the 1 minus t element to adjust the tax shield. Okay, I'll give you the formula. I'll give you the formula for it. Okay, now first, before going on to the IRR, I'll be calculating the cost of bank loan, because cost of bank loan is simpler. If there is a term loan, then it doesn't have any market value. So if any source of finance do not have any market value, like bank loan, let me repeat, if any source of finance do not have any market value, like bank loan do not have any market value, the interest calculation is very simple. You just have to take the interest rate and 1 minus t. That's all. This is what to be done. So the interest rate on the bank loan, you can see from the statement of from this question that in the second last line, bank loan has a variable interest rate of 4%, and the tax rate is, annual tax rate is 30%. So straight away, what you will do, take 4%, 1 minus 0.3. This is the tax shield effect. So this gives you, and multiply it by 100. This gives you the cost of the bank loan, and the cost of the bank loan is 2.8%. So that's the cost of the bank loan. Okay, let me give you the formula for irredeemable bonds. Please note down the formula. It is if the cost of debt, now we are talking about irredeemable items. So cost of bond will be interest rate multiplied by 1 minus t, divide by the market value. This will be the formula. So it's similar, just there is a difference of the interest effect in preference shares. As preference shares dividend is not deductible from the taxable income, you can't save tax on it, so its cost will be higher. Preference shares will cost you high, and in case of loans, there is a 1 minus t which reduces the numerator, therefore it reduces the cost also. So in case of irredeemable items, the formula will be as follows, right? So irredeemable items formula, cost of preference shares is dividend divided by market value, and cost of bond, if it is irredeemable, then interest 1 minus tax rate, and IRR is used in case of the bond is redeemable. In irredeemable marketable bonds, I'll be giving you this formula sheet as well when I'll be giving you the day 3 worksheet. So you will find this on that worksheet. Okay, and this is for the term loan. Okay, students, let's move ahead. Back to the question. So let's calculate now. One of the item is left, and that's cost of bonds. So cost of bonds will be calculating the internal rate of return, the IRR. I hope you remember the formula for IRR. Obviously you would be. So you for calculating an IRR, we'll be calculating two NPVs of the bond. Now, how will we calculate the NPV of the bond? It is similar. It is similar to how we calculate in other case. If we case an NPV for project, we first calculate the cash flows, right? The receipts and payments of that investment. So in this case also, we will be considering the receipts and payments of the Omar, it's okay. These formula are okay, which you are showing. You can show this much. Okay. Now, it's just a bit of variation, that's all. Okay. So first of all, we need to know the cash flows, and then we will take the present values at two different rates. Now, what are the cash flows of a bond? We need to know about that. So there are three cash flows of a bond. One cash flow is the investor buys the bonds. So when he buys the bond, he'll be making a payment. So the market value is the amount at which he purchases. So there will be a payment. Then once he buys the bond, he will be receiving interest. So interest will be an inflow for him till the bond is redeemed, right? And then once the redemption date arrives, he will be receiving the redemption payments. So the investor will be first making a payment to buy the bond at market value, then he will be receiving the interest, and then afterwards, when the bond is redeemed, the investor will get the redemption amount in return. So there will be three cash flows that will there are three cash flows that will be occurring in case of bonds, and these cash flows are as follows. So first of all, the market value or the purchase price of bond, right? Then the interest shall be net of tax. And then the redemption amount. These are the three cash flows associated with the bond, the receipts and payments, the present values of which we will be calculating. So the years. So the market value of the bond, this much amount will be invested at year 0. The market value of one bond, this will be taken in the cash flow column, and the cash flow column is minus 104.5 because this is the payment amount. Then interest will accrue till 6 years because the life of the bond is 6 years. And then by the end of 6th year, the investor will receive the redemption amount. So the interest is 7%. But if we take net of tax 30%, it will make 70% of 7. The bond is of 100. Remember, the face value of the bond was 100. So the interest payable will be calculated at 7% on that $100 bond. So $7 is the interest on one bond, and 30% deduction of tax leaves back 70%, which is 4.9. And then the redemption amount, the question says that the bond will be redeemed at a 5% premium on redemption. If you look at the question, let me show you that it says the 7% bonds are redeemable at a 5% premium to their nominal value of 100 per bond. So the bond will be redeemed at 105. So this will be an inflow amount. Now we will calculate present value. We have to take two rates. Usually we take one of the rates that we take is the rate which is given on the bond. So the rate given on the bond, and the other one can be any rate. Over here I am taking 5%, the first rate, and second one you can take any two rates, it doesn't matter, any two rates can be taken. Bukinia, I'll show you the platform, CB platform tomorrow, to show you all the functions that are available on the CB platform. So let's have a look tomorrow on it, so that you come to know that what functions are available over there, right? There's a limited function available over there related to it. Okay, so now present value fraction. So at year 0, if the cash flow occurs, the present value fraction will be 1. It is itself a present value, right? So then if you talk about interest is an annuity. Look at the annuity table at 5%. The present value fraction at 5% is 5.076. And look at the compound table for 6 years. 1 plus r to the power minus n. So at 5%, this is 0.746. So calculating the present values at 5%, this gives you 104.5 into 1. And then okay, so this is a present value which has been calculated at 5%. Now you get the net present value at 5%. So it is minus 1.296, or if we take it up to 2 places, it is 1.30. Now take another rate. For example, the present value at 5% is minus 1.3, it is negative. So take a rate which is lowered, take a lower rate, so that the present value increases and you get a present value which is positive. So taking a 4% rate, the present value fraction will be 1. For 6 years, it will be 5.242. 5.242 is annuity fraction, as the interest will accrue for 6 years. It's an annuity. And then for the 5th year, 0.79 will be the compound table fraction. Okay, then calculating the present value again. Now this is at 4%. No, you have to show the working. Dorota, you have to show the working of cost of debt. You can't use the formula in section C, right? Section C will be bearing marks of workings, right? In year 0, the cash flow won't be 0, because the investor cannot buy the bond at 100. He will be buying the bond at the market price. So that's why at year 0, market price has been used. So the amount which the investor has to pay in order to buy the bond, that will be used, right? So it won't be the face value, but the interest is always calculated on the face value. Yes. For section C, please do not use IRR formula or function. Okay, now the present value at 4%. This is 4.14 approximately. Now, putting it into the IRR formula, the lower rate is 4% plus The NPV at the lower rate, which is 4.14 divided by the NPV at the lower rate 4.14 plus minus minus becomes plus 1.3 and then multiplied by 5 minus 4. So this gives you an internal rate of return which is equal to 4.8%. So that's your cost of debt. So there you go, you get now all the cost of capitals, different types of capitals which business has used in this question. So our table is complete now. So putting 4.8% over here. Now we are in position to calculate the weighted average cost of capital. So our weighted average cost of capital is as follows. First, there are 4 items, right? What I have to do, I have to multiply each item one by one. 12.1% multiplied by the value of the equity. 12.1% is the cost of equity. So I've taken this and then I'll multiply it with 37,600 and divide by the total amount. So this gives me the portion of the equity that becomes part of the WACC. So it is 37,600 divided by 42,935. This is the first portion of my WACC. Now moving on to the next portion. Next portion is cost of preference shares. So for cost of preference shares, it is 10%, right? So 10% multiplied by the value of the preference shares is 1200 divided by the total value of all the financing items, 42,935. Then moving on to the next item, which is bonds. So we'll take one by one, take the cost of each capital item or each financing item, and then we'll keep on multiplying it with its market value out of the total market value. So now the bonds market value is 3135 divided by the total market value 42,935. And then finally the cost of bank loan, which is the lowest, 2.8%. Now note over here, as I said earlier, the highest is the cost of equity, then the cost of preference shares, which is closer to equity, and then the lowest is 4.8% and the 2.8%, which is cost of debt. So the company can reduce its cost of capital by putting in and obtaining more funding from the debt capital rather than from equity capital. The more you have the equity capital, it is very expensive, so it will increase your cost of capital, and ultimately if your cost of capital increase, your NPVs will become low or it may become negative. So it's better to manage the funds and capital structure properly to have a good low cost of capital. Okay, so loans are 1000 value divided by the total amount, which is 42,935. Okay, this gives me the WACC, and the WACC in this case is 11.3% approximately. Okay, friends, let's move ahead. Okay, there's one more part in this question. The theoretical part, let me tell about it. I have already told about it, but I'm giving you a written answer as well. See, in the part B, they ask, discuss how the capital asset pricing model can be used to calculate a project specific cost of equity for AMH company, referring in your discussion to the key concepts of systematic risk, business risk, and financial risk. So let me explain you how CAPM can be used to do this. Okay, so moving on to this point will be helping you in the next question as well. So I'm explaining it over here. So what happens that let me tell you first. Okay, I'm writing the answer along with it. There is an explanation also. What do we mean by a project specific cost of capital? First, now remember one thing, that there is a formula for capital asset pricing model. Let me show you the formula. Okay, so students, let me explain you what do we mean by a project specific cost of capital. So please look at the green patch. Where I'll explain you. Okay, Vivek, I have already taken the interest as 70% in the IRR working. So that's why for the bonds, I have not taken 1 minus t separately. I've taken 0.7 now. 7 multiplied by 0.7 makes 4.9 over here. Let me show you. Over here I have taken 4.9, right? So this that work happens over here. Okay, now let's talk on the project specific cost of capital. Okay, so students, look on the green patch. I'm explaining from there. What happens that in this formula, if you can note, there is a beta. Now this beta is the magnitude of the risk. Magnitude of risk. So whenever you invest in a project or in a company share, you are taking some risk, right? Now there are two types of risk which you are taking. One is business risk and one is financial risk. Business risk means that the chances of fluctuation in sales of a business, and financial risk means the chances of the fluctuation in profits which affects the EPS badly in times of lower profits. So if your profits are low and you have too much loans, you will be having too much interest. So all of your lower profits in bad times will be used in paying interest, and no net profit will remain. So no EPS for the shareholders. But when the company earns too much profit in good times, the interest cost remains same. So too much will be left in profits to be divided over less number of shares, because the company do have interest and company have issued loans, so they will be having lesser shares. So a great EPS. So there will be a big difference in EPS in good times and in bad times. In bad times, no EPS, no earnings per share, very less earnings, and in good times, great earnings. So there is a fluctuation. This fluctuation is basically making the project riskier. So those places or those investments where there is a variability means there are fluctuations in cash flows in future, those projects are said to be risky and they are unpredictable. So are all projects of same risk? Some projects cash flows will be smoother, some will be very fluctuating. So they are not of the same risk. They are all not of the same risk. And further, the companies are also not of the same gearing levels. Some are less geared and some are highly geared. So there are two types of risk. If you look over here, that beta, this represents one, the business risk. This is due to the effect of sales. This is the effect of sales. And secondly, it represents the financial risk. The business risk is due to the revenues, fluctuation of revenues that are expected in future. The more the revenue fluctuate, the more will be the business risk. And the more there are loans, the more this company geared, there will be more financial risk. So the beta will be very high over here. So high risk means a high return. So if there is a bigger beta, the cost of equity will be higher, right? Now, how the formula is formed? This RM is the market rate of return. Market return means, okay, if you invest in a group of projects or a group of shares, then it is known as a market portfolio. The return from that portfolio is known as market portfolio, and this is a risky portfolio. If you invest in projects, they will be risky. If you invest in a group of shares, a good group of shares, you diversify the risk, but still some risk remains. The non-systematic risk gets diversified, but the systematic risk remains over there. Now, what is the risk free rate? RF is the risk free rate. So the difference between the RM, the market portfolio, which is risky, and this is the risk free rate. Risk free rate means there is no risk. The government securities are risk free. So in this case, suppose there is a 5% risk free rate and there is a 11% market rate. So what is the cost of the risk? The cost of the risk is 6%, and the beta is 1.2. Suppose 1.2% means 1.2 means the investment is more risky than the market portfolio, then the formula will be applied like this. The risk-free rate is 5. 6 into 1.2 makes 7.2. So the cost of equity will become 6 into 1.7.2 plus 5, 12.2. This will be the cost of equity. This is fictitious. The figures are fictitious. I'm not taking these figures from the question. We'll be doing from this question as well. So I'm just explaining this concept first. So what happens that 12 into 6 gives you 7.2. Now suppose the beta would have been, suppose in the same case, the project would have been less risky than the market portfolio, and the fluctuation in the cash flows in future are supposed to be lower than the market portfolio, then the beta will be less than 1 and the beta will be 0.8. So if I multiply 0.8 by 6, then the cost of equity is going to be 9.8%. So this is for a low risk project, right? And this cost of equity is for a high risk project, right? And beta represents systematic risk. Systematic risk includes the business risk and the financial risk, which has not been diversified. The non-systematic risk is basically the industry-based risk, which due to combining investments, you get mitigated. So that reduces due to combining securities. The fluctuation in profits goes down because some securities perform well in some times and the other securities perform, or other shares or projects perform better in some other times. So it makes your cash flow smooth. So once your cash flow gets smooth, means the risk has reduced. Once your cash flows fluctuate and variate, then you have a greater risk. So all of the non-systematic risk can be smoothed, but the fluctuation of the effect of the systematic risk cannot be fluctuated, and it represents business risk and financial risk. And business risk is due to revenue, and the financial risk is due to the gearing effect. And this is what the whole concept about. So each project is not same. All projects are different, either due to the financial gearing or either to the business gearing. So each project should have a separate cost of equity. And if it is a separate cost of equity, then the weighted average cost of equity will also vary. So this is the concept. So let's read this green paragraph, what it says. So it says that the beta for projects that we evaluate will not be the same for different industries. In which the project will operate, for example, a beta which represents, the beta for the projects that we evaluate will not be the same for different industries in which a project will operate. For example, a beta which represents systematic risk will be different for a textile project compared to an automobile manufacturing project. Why? Because the automobile business is different and the textile project is different. The risk will be different. The profits will fluctuate in a different manner in the future. So that's why the business risk is different. Then when beta is different, then KE will be different. And therefore the WACC will also be different. So there should be a separate cost of equity for the separate industries. But if you are in the same industry, then the beta will be the same. If even after obtaining further funds and investing in a project, your capital structure do not change, your percentage of debt and equity remains same, the financial risk also remains same, then your beta will not change, right? So when will the beta be different? One, you are investing in a new industry. Second, your financial risk change. And third, the project is very big compared to the current, so it will change your weighted average. Okay, same WACC cannot be used to calculate two projects that are in different business sectors. Now that's the explanation for it. In order to calculate different WACCs, different betas, and therefore different cost of equity will have to be calculated. So that's the explanation behind this. How we will calculate the different betas will be using one of the questions ahead to do this. So let's move on to those questions to see how project specific betas and cost of equities will be calculated. Project specific betas and cost of equity will be calculated, and the WACC will be calculated. Okay, so I hope the things are clear to you regarding this project specific cost of equity. Okay, this was a conceptual item. Okay, so let's move on to the next question. So this was the answer to the part B over here of 8 marks, right? So in this I have basically discussed these factors. So how it will be marked, let me tell you. First you need to tell about the systematic risk and non-systematic risk. Then non-systematic risk will be diversified, systematic will not be. Now systematic risk involves a financial risk and a business risk. What is the business risk? Arising as a result of sales. Financial risk arising as a result of capital structure, that how much geared the company is. Then you will go on to the that all projects that we start will not be in the same industry. If the industries are different, the business will be different, the variation in cash flows will be different, systematic risk will be different, ultimately the cost of equity will be different, due to which the WACC will be different. So likewise you will be discussing all these points. So one by one you will start getting marks. Once you make the links, each point will give you 1 mark. Okay, so don't hesitate in writing, never hesitate in writing. Just plan your answer, start writing in a good sequence, right? So you will start getting marks. Unsystematic risk means that industry specific risk. Like suppose if you have invested in an automobile industry, it would have been severely affected in this pandemic, but food business have not been. So if you had an investment in a food and beverage business plus in automobile sector, so in these pandemic conditions, the food businesses are going very fine, but the automobile are not. So at least if you are invested say 50%, you're getting some returns on it, right? But if suppose an investor invests all of the money in the automobile sector, what happens? He will be exposed to the automobile sector risk and he will be earning nothing. So he's in problem, a big cash flow problem. Now by making portfolios you can reduce that risk. Now what happens once the pandemic get over and the economic conditions improve, then the automobile sector will earn better, right? So which one can be diversified? Non-systematic can be diversified, the industry specific. Now systematic risk arise due to the economic factors, inflation, all will be affected by inflation, and to some extent they will be affected by inflation, the interest rates. So the risk, the fluctuation that arises as a result of macroeconomic variables is a systematic risk which cannot be diversified fully. Okay, so moving on to the next question, BKB. So students, please go through it. So you have to do it a bit faster. So we have to start with working capital also today. Okay, in 2 minutes I'll be starting this question, the BKB. Please go through it properly so that I don't have to read in a way that I don't have to refer to things, because the time is short. I will refer to the important areas, but not to all areas as they are present in the question. So Umar, you can ask if you need to ask some extra questions, you can ask me individually also. You have my number on the group, so it doesn't matter. I'll ask you separately. I'll tell you separately also about those steps. Actually, there are some areas in which if I talk about in the generally, it may confuse others as well. So I have to remain a little planned. No, we don't get uh, constructed response questions of risk management and business valuations. And obviously, the three areas which are being tested in the CRs is working capital management, investment decisions, financing, and cost of capital. Yeah, you can go through the ACCA global syllabus outline to find this out. They're specifically mentioned over there. Yes, we'll be doing some MCQs tomorrow, and obviously we will be doing some MCQs of actually it is we are using the scenario types questions instead of just using the MCQs. So as in scenario type, we can cover both, na? We can cover both MCQs and scenarios as well. So once we start risk management, in risk management, obviously we'll be doing the MCQs and in tomorrow's class also, most of the areas are business valuations and those type of areas, which will be doing MCQs over there. In financing also, I have given you two MCQ type, this scenario type questions in the beginning. I gave you as an assignment. So if you like to try it out, please try it. I'll give you the answers for it. I can give you some extra questions as well afterwards. Okay, so let's start doing this question, students. This question now, see, it has various sources of finances. Let me highlight some important points in the beginning. One of the finance is ordinary shares. Second is convertible bonds, 7% convertible bonds and 5% preference shares. So these three items are there as source of finance. And in this case, see, they have given the equity beta. So whenever they have given you equity beta and risk premium and risk-free rate of return type things, so this means you have to use the CAPM, and CAPM is a better model. So if you are given with dividends which are growing and you are given with beta as well and the risk premium data as well, so if both of them are given, then what model should be used? Dividend growth model or cost of equity? So you will be preferring the capital asset pricing model because it is considered amongst financial management people to be superior to the dividend growth model, right? And why, we will discuss a bit after doing this question. Okay, so let's start doing this question again. First, we'll calculate the market values of these three items, and then we will calculate the cost of these three types of finances. So let's start. Okay. So we'll be taking the market value of equity, then market value of convertible bond, and market value of preference shares. Then KE will be the cost of equity, KCB will be the cost of bond, and KP will be the cost of the preference shares. So moving on to the market values first. They have given the market value of the whole company's equity, which is 125 million, right? So this will be taken over here as market value, and then the next paragraph is on convertible bonds. So they have given you the market value of the convertible bond as well. The market value of the convertible bond is 21 million in full. So this will be considered over here, and the market value of the preference shares is 6.25 million, which is given over here. So this is ready-made given to us. So it's just plugging in figures. Okay. So market value of equity is 125 million, then 21 million convertible bonds, and then 6.25 million is the convertible preference shares. This gives you 152.25 in total. Now moving on to the cost. So for cost of equity, you have to use this formula, which I recently explained, the CAPM formula. So instead of this market return and risk-free rate, they have given you the risk premium. Risk premium is the difference between the risky rate of return, the market rate, and the risk-free rate. Risk-free rate is on securities which are risk-free. So that's known as the risk premium. So over here in question, they have not given you market rate and risk-free rate. They have given you the risk premium. So we'll directly be taking the risk premium over here. So in this case, the calculation is as follows. 4% is the risk-free rate, and the beta is 1.2. This means that the investment is more risky than the market portfolio, as the beta is greater than 1. Okay, so the cost of equity also will also be greater than the return which is expected from a market portfolio. And if beta is less than 1, then the cost of equity will be lower than the market return. Okay, so the risk premium is 5%. This gives you a cost of equity which is 10%. So that's our cost of equity, 10%. Now moving on to the cost of convertible bonds. Before moving on to the cost of convertible bonds, let's calculate the cost of the preference shares. So in case of preference shares, we need to know the dividends first. So dividend will be, it's a $1 preference shares, and the preference share, the rate on the preference shares is 5%. So the dividend will become 0.05. and the market price per preference share will be, there are 10 million preference shares. As per question, you look, preference shares are worth 10 million, which are at face value in the balance sheet. So the total market value was 6.25 million of the preference shares divided by 10 million number of shares. So 6.25 divided by 10 million gives you the market price. So the formula is dividend divided by the market price. So 0.05 divided by 0.625. This gives you the cost of preference shares, the same formula which I used earlier, right? So first I calculated the 6.25 was the preference share or value of the all the preference shares. I divided it with the 10 million preference shares which were shown in the balance sheet, and then multiplied by 100 to arrive at the cost of preference shares, which is 8%. Okay, so one more item done. And now let's look at the most important one, which is cost of convertible bond. We need to know the cost of convertible bond. So what's the cost of convertible bond? Again, is the cost of convertible bond redeemable or not? It is redeemable, so we'll have to know an IRR of it. But there's a difference, a big difference in the working. Let's check what's the difference. So the working will remain same as that we did in the previous question for the bonds. Same working I will do. Even I'm taking the same pattern. Just the changes I will discuss, that what's the change. Okay, so what happens? One of the rates I'm taking the same as the preference shares rate, which is 7%, and the other one I will decide once I get the NPV. If the NPV is negative, I'll reduce the rate, and if the NPV is positive, I'll increase the rate. Okay, now the first cash flow, the investor will buy the bond, convertible bond. Now what is a convertible bond? Let me tell you about the convertible bond. Convertible bond is a bond which at the time of redemption gives the option to the investor. No, the market values given in the question are for the whole company, for all the shares, for all the loan notes, and for all the convertible bonds. Okay, so first of all, let's take the cash flows and let's discuss the convertible. What are convertible bonds? So convertible bond is a bond which bears an option at the choice of the investor that he can either ask for cash at the time of redemption, when the bond get mature. For example, in this case, after 5 years, he can ask for $100, which is the face value, or he can ask for the number of shares, which are 19. So he can ask for conversion into the ordinary shares. He can ask for 19 ordinary shares. When he will ask for 19 ordinary shares, if the value of the 19 ordinary shares after the 5 years time at the time of redemption is more than 100, only then he will be asking for the market value of shares. Otherwise he won't be asking for the market price. So for the conversion, so he has to decide at that time. So in this case, we will predict that what will be the market price after 5 years time. If the market price of 19 shares exceed the $100, which is the cash amount to be repaid, only then the investors will go for the conversion, and in that case we'll be taking the redemption amount as the market price of the shares rather than the redemption amount which is given in the convertible bond option. So on year 0 the market value of the bond was 105. Now how did I get 105? It is like this. I'm working on one bond basis, right? And they have given you 21 million, which is the market value of all bonds. You can take 21 million as well, and then you have to work on 21 million bond for interest as well and for redemption amount as well. I'm working on one bond basis. So if you take value of one bond, 21 million is value of all bonds divided by 100. If you divide by 100, you get the number of bonds, right? 21 million divided by 100 gives you the number of bonds, and then multiply it for in order to calculate the number of bonds, just check over here that the capital is of 20 million. So you need to divide 20 by 100 million in order to know the number of bonds, right? So if you divide 20 million, which is the face value, by 100, you get the quantity, right? So that's what I am going to do. First, I'm going to find the quantity, right? So let me show you the working that I was doing. So multiply this by 20. So this is how you get 21 multiplied 21 divided by 100 multiplied by 20. Okay, let me do in 2 steps. First, calculate the quantity of convertible bonds. So this is 20 divided by 100. So 0.2 million convertible bonds are there. Now 21 million divided by 0.2 million convertible bonds. This gives you the market price, which is 105. So you could have done this directly as well in this way. 21 multiplied by 100 divided by 20. Okay, so this is the purchase price. This will be taken in minus. This will the payment amount to buy this, and then the interest on this is 7. So 7 multiplied by the tax rate. So tax rate is 30%. So multiply it by 0.7. This gives you the interest which will occur from year 1 till year 5. And this is going to be 4.9. Okay, now redemption amount. This is the thing which we need to find out, that what will be the redemption amount. We have to check that whether the redemption will be in cash or conversion into ordinary shares. So in order to check this, cash redemption as per question please note a few things from the question, that the current ordinary share price of BKB company is expected to increase by 4% per year for the foreseeable future. This means that for the 5 years, the price will keep increasing, and the bond is going to be converted into 19 ordinary shares per bond. So this is the conversion ratio. And the conversion date is going to be same as the redemption date. Okay, so let's continue with the convertible bonds working cost of debt. So let's check. So cash redemption is of $100, and value of shares, value of 19 shares in fact against each bond in 5 years. So right now the market price of each bond is $5. So $5 multiplied by 1.04 to the power 5. This gives you the market price. So multiply $5, which is the current market price of the ordinary share, into 104% for 5 times. Multiplied for 5 times because the prices are increasing 4% every year for 5 years. So this will make the market price 6.08. So that's the price. So the value of the convertible bonds, if multiplied with 19 ordinary shares, becomes $115.52. So this will be the redemption amount in 5 years time. Okay, now at 7%, the present value fraction at year 0 will be 1. From year 1 to 5, annuity fraction will be 4.1 at 7%, and 0.713 will be the present value fraction. This gives you minus 2.54. This means that we have to take another rate which will be lower than, so I'm taking a 6% rate, and at 6% the present value fraction will be 1, annuity fraction will be 4.212, and the present value fraction at 6% for 5 years will be 0.747. This gives you a present NPV which is positive. The lower and the higher NPV, the lower and the higher rate. So we'll be putting in the formula. The lower rate is 6% plus the NPV at the lower rate, which is 1.93, divided by 1.93 plus 2.54 multiplied by 7 minus 6. This gives you an IRR of 6.43%. So the cost of convertible bond is 6.43%. So our table is complete to calculate the WACC. Let me show you the workings again, the values again. I'm shading the main values, the summaries of the main values in yellow for your view. The market values and the cost which we have calculated is as follows. And now we are in position to calculate the WACC of this question. Let's calculate the WACC. So the WACC becomes 10% is the cost of equity multiplied by 125 divided by 152.25. The first component, which is cost of equity. The next component is cost of convertible bond. So 6.43% multiplied by 21 divided by 152.25. Then plus the cost of preference shares, which is 8%, multiplied by 6.25 divided by 152.25. Okay, so this gives you the WACC. Which is 9.4%. So that's the WACC for this question, weighted average cost of capital. Okay, students, this is done. Now let's do a project specific cost of equity calculation in the next question. Five is the market price of ordinary shares. Where did it come from? Okay, let me show you. No, in the cost of capital question, Orlando, always we will take cost net of tax, because the income which is generated will be taxed at 30%, right? Okay, and if Vivek, if redemption amount is not given, that there is premium or something like that, then we will be taking the face value only. Yeah, so in case of convertible bond, we will be using the higher amount. If cash redemption is greater than the market price, obviously the investor will maximize his profits. Okay, Arslan, I will try my best. Yeah, it's point Temur, the quantity was 200,000 or 0.2. You are right. Okay. And Said Ahmed, did you got the preference share working? It was simple. The dividend on each share divided by the market price of preference share, as in the previous question, right? Okay. So students, let's move on to the next question. BKB's first working is done. Now the next part is discuss why market value weighted average cost of capital is preferred to book value weighted average cost of capital. So they mean to ask that why we are not using book values over here in the WACC working. Why we didn't use book value of share capital? Okay, one of the question was, how did I get $5 market price? So it is like this. Look, the market value of all the shares is 125 million, right? And ordinary shares are 25, right? So 125 divided by 25. This gives you price of one share. So that's how I get it. Okay. So let me give you an answer to the weighted average. Why do we use market value and not the book values which is in the balance sheet? The main thing is that all the investment decisions take place on the basis of market value, and usually equities values will increase, but the loans value will not increase by that much, right? So if the value of equity increases and you keep taking the balance sheet values, so the weight of the equity will be lower, and the cost of cost of capital uh, will also be incorrectly calculated, and lesser weight of equity will be taken. And you remember, the equity is very expensive, so the weight of the equity, the proportion of the equity should be accurately calculated. And the main danger is that the market values of equities change rapidly, otherwise the debt instruments market value are not much different from the face values. So the balance sheet value and the market values are almost same for the liability items, but equity items change and the cost of equity is very high. So if we take at balance sheet values, book values, the proportion of equity taken in WACC will be lower. Ultimately, WACC will be lower and the NPVs will get wrong. You'll be getting positive NPVs for bad projects as well because your WACC is lower. So NPVs will come positive. So you'll be picking up negative NPV projects as well. Looking at that, NPVs are coming positive due to your lower WACC. So that's the reason. No, student, remember, if they have not asked you to calculate or prepare a calculation, please do not do it. Simply go for an explanation. It is always easier, right? Because if you commit an error in that calculation, then what happens? And if the data is missing over there and you cannot calculate it, you will be losing some time. It's better to go for a paragraph. It's easy to write and it's faster to write the paragraph. Idrissa, please take care. Okay. Said Amir, see, 6.25 is the market value of all the preference shares. And in the balance sheet, the preference shares is appearing at 10 million. And over there it is written that the face value of preference share is $1, right? So that's why I've divided it by 10 million, because 10 million preference shares will be there. Their face value is $1. So 6.25 million total market value divided by 10 million gives me the market price. Okay, so let's move on to the next question now. I'm putting in the comment over here on which you can view it afterwards. On this topic, the weighted, why do we use market values? So the explanation which I gave right now regarding market values, I have posted over here. So when you will get the sheet, you will find it out. Okay. So now moving on to the next question, card company. This is a question which is based on calculating project specific cost of equity. Please go through this question. So welcome. No, it won't be emailed. I am sharing those Excel sheets on the WhatsApp group, and I've already shared for till tomorrow's work. A little bit of tomorrow's work is left, which will be shared today, maybe tomorrow morning. Okay, please go through the card company question. I'm giving you around 3 minutes to read it, and then after this question, we'll be moving on to the risk management work. So it's very important, risk management. You may get it in the scenario type question or in the objective types. Okay, in calculating the project specific cost of equity, what we need to do? See, you have been given, remember the discussion I did earlier, that the betas of two industries will not be same because the businesses are different. So over here, they have given you beta of a proxy company that is already present in the industry in which you are going to diversify. Diversification means you are investing in a new type of business. So in diversification, you have to calculate a specific cost of equity, which is different from the current cost of equity of the company, right? Because the current business is different and the new business will be different. So in case of expansion, you can use the current cost of equity and the current WACC, because if you expand means the same business you are doing. So the cost of equity won't change as the business risk will remain same. And the financial risk will also not change. Now this beta 1.08 will first have to be de-geared. De-geared, why it should be de-geared? Because if you look, the financial risk in it is 75%. This company's the proxy companies finance 75% by equity and 25% by debt. But the company, the card company, it is not this much geared. The gearing ratio of the card company is different. So we will have to basically remove the effect, the gearing effect of the proxy company, right? If you remove the gearing effect, so there are two types of risk involved in beta: financial risk and business risk. So financial risk will be eliminated. Only the business risk will remain, which is relevant to us. So in that business risk, we will add our own gearing ratio and we'll re-gear it. So first, what we are going to do, we will de-gear the beta. So what's the formula for this? We'll be having a break after this question. Okay. First step will be de-gear the financial risk, de-gear the beta of the proxy company. I gave you the formula for it. Let me pick it from above. So that's the formula. For de-gearing the beta. So let's first de-gear the beta. So de-gearing means calculating beta asset. Beta asset means only business risk remains. Beta asset is a beta ungeared, also known as beta ungeared. Ungeared beta means no financial risk effect, only the business risk in there, right? So, and BE means beta equity. It is the geared beta. So proxy companies geared beta is 1.038, right? And we will multiply it by 75, which is the equity percentage of the proxy company. Then divide by 75, which is equity, plus the debt. Debt is 25, and 1 minus 0.3, which is the tax rate. So by doing this, we get the beta asset, which is 0.84. Right now, 0.84, this will always be lower than the 1.038 because you have removed the financial risk. So if the risk reduce, the beta will also reduce. Now the next step is re-gearing the beta. Now re-gear it in order to bring in the effect of the gearing of card company, the own gearing effect. So re-gear the beta in order to bring the effect of financial gearing of card company itself. Now, how will you calculate the gearing effect? To calculate the value of equity, now we are going to calculate BE. B is the beta, which is geared beta. So for this, I need beta asset or beta ungeared, which is 0.84, and then I want the value of equity and debt of card company. So I have to calculate it first. The market values of the card companies beta and equity. Okay, so let's calculate the market value of equity, which is E, and the market value of debt. Market value of E is market value of equity, and market value of D is market value of debt of card company. So it is, let me show you. That the card company, they say it has 8 million shares outstanding, and the ex-dividend market price of 7.16, right? So 8 multiplied by 7.16, and then the market value of each bond is 103.42, and the nominal value is 5 million, right? So 8 million shares multiplied by 7.16, and then market value of debt will be 5 divided by 100. 5 million divided by 100, which is the face value, and multiplied by the market price 103.42. So this gives you the market value of debt. So 57.28 and 5.17. This gives you the total value. Okay, so let's put in the values. So the value of equity of card company is 57.28 plus 5.17 multiplied by 0.7, 1 minus 0.3, and then divided by the value of equity, which is 57.28. This gives you again a geared beta. So now the financial risk has been added to 0.84, which was just representing the business risk only. So this 0.84 represents business risk only. So this was the way that we obtained a beta of a company which is present in the new industry in which we are going to invest in. Remove the financial risk from that. So you are left behind with the business risk only, which was relevant to you, and then put your own financial risk into it and add to it by using this BE formula. So this gives you a beta equity of 0.89. So see, the beta of the proxy company was higher as its financial risk was higher. This company, card company, is not that much geared. That's why they are getting a lesser beta equity. So now the cost of equity, we will use the formula risk-free rate. Risk-free rate is 4% plus the beta, which is 0.89, and then the risk premium is 5. So this gives you the cost of equity, which is 8.45%. So this is how we calculate the project specific beta or the risk adjusted beta, and the cost of equity, project specific cost of equity. Now if you can have some workings further on it by putting in the cost of debt by IRR and cost of preference shares. You may have to be be required to calculate the back also in this case, but over here you have to calculate the cost of equity. That's all. Now, so students, discuss whether the next part is discuss whether the dividend growth model or the capital asset pricing model should be used to calculate the cost of equity. Which model should be used? So let me discuss. Let me give you an answer, and then I'll be giving you a namaz break and a refreshment break and prayer break. You want a break first? Okay, let's take a break. I'll just take 2 minutes to explain this point, and then I'll be starting with risk management after the break. So mainly we'll be starting with risk management now. So please get refreshed so that we can concentrate on the risk management work immediately after the break. So we'll be doing the money market hedge and the forward contracts and conversion type questions in the beginning of today's class, right? So see you in 10 minutes time after the break. Have a good break. Pray for me as well. Welcome back, students. Dividend growth model is basically Saad Muhammad Ahmed. This is for you. Dividend growth model and dividend valuation model are not same, right? Because in dividend valuation model, growth rate is not there. They assume that the dividends are not growing. If the dividend are not growing every year, then we use dividend valuation model, right? And if the dividends are growing, then we use dividend growth model. Usually we assume that dividend is growing every year, right? So the dividend growth model is more practical compared to the dividend valuation model. Okay, so students, let me give you the part B's answer, that why is cost of capital asset pricing model better? And then we'll move on to the hedging concepts. So that's the answer which will be appearing in a minute's time on your screen. So students, the first reason behind why cost of capital asset pricing model is better. So first reason is the growth rate used by dividend growth model is a historic growth rate. The growth rate basically represents the past growth rate. Now it is not necessary that in the future also the growth will continue at the same speed. So it is assumed that it will continue in the future as well. So which is not an appropriate assumption. So dividend growth models, this is the weakness of dividend growth model, right? So one of the ways to prove one of the models right and the other one wrong is first give the weaknesses of one of the models and then gives the strengths of the other one. Then there are market imperfections that do not allow to find the accurate market price. So in the dividend growth model, we use market price in the denominator. So the market price which exists in the denominator, it can be different from the price which should have been in the market due to the speculation activities and various brokerage costs, etc. So imperfections are there in the market. Imperfections are, if not there, the market price will be different. So we need a perfect market price which is based on performance only, not on the basis of the guessing and speculation work and all. Now the strength of CAPM. CAPM is based on a very strong theoretical concept involving a well diversified portfolio. That's why it is being preferred. But remember, the financial management and accounting and these are all art, decision making, and this is all art. So when these art have strengths, these should also have weaknesses as well, because this is not a science, this is not a law. So now what is the weakness? Although CAPM may also sometimes don't give better results due to poor estimation of the plug-in figures. Like if you don't get the risk-free rate correct, or you don't get a correct market rate and beta, then the CAPM will also not give good results. So that's the weakness point of CAPM. So this is a discussion on which you can explain that. Yeah, on dividend assumptions and price assumptions. So these are weaknesses of dividend growth model. And then the portfolio diversification and systematic risk concept. This is a stronger concept on which this CAPM has been based. These are strengths, right? So this was the strength of CAPM. And then I gave a limitation to wrap it up. You can write other points as well, but this is just for 4 marks. So see, I have given 4 small points to make my answer complete. So each point I get 1 mark, right? Okay. So now moving on to the risk management questions. So slowly and gradually we are moving towards the end. Tomorrow will be the last day, and we'll be left away with some business valuation and some small other topics related to when we're doing business valuation. These formula will come again, these cost of equity and all. That's why we have covered cost of equity over here, so that we can do it together and we can do it faster, as we will be remembering this tomorrow, so it will get faster over there. And tomorrow we'll be doing some risk management work at the beginning and then business valuation, because we won't be able to finish the risk management work today. So we'll start today and then end tomorrow, and then we'll do the business valuation and other areas. Okay, so let's start with risk management work. So there you go. This is the worksheet for day number 4, risk management worksheet, and the question is Nedwin company. So this is the first question, and this question involves hedging, forward market hedge and the money market hedge. These are the 2 most important hedge which can be asked in the exam as calculations. And one of the forward rate agreements. This is an interest rate hedge which can be asked. So 3 of the hedges calculation are being asked, and those 3 are money market hedge, forward currency hedge, and forward rate agreement, which is for interest. Otherwise, all other hedges will be asked only on theoretical basis. Descriptive answers will be asked, and descriptive means that there will be MCQs or objective type questions which will be theoretical. In that regard, you won't be asked any blanks or calculative work on other hedges. So remember these 3 hedges. Okay, now what is hedging? First, let me tell you what is hedging, because it is very important before we start this question that we know what hedging is. See, if the business expects that in future its cash flow can be low or high, like in case of a foreign currency receipt, right? If the foreign currency weakens down, so due to weakening of the foreign currency, you will be receiving lesser cash in the local currency, so you incur a loss. Then on the other end, if you have to make a payment to a foreign supplier, in that case, and in the foreign currency, so in that case, if the foreign currency gets stronger, you will have to pay more of the local currency to buy that foreign currency to make the payment. So you don't know that whether in future what will be the spot rate, what will the spot exchange rate of currency conversion exchange. So due to this, the cash flow is variable. So if the future cash flow can be high or low and you don't know, you're not certain, so you may incur a loss because it is not in your control. Likewise, if there is an interest payment and the loan gets expensive if you borrow in future, so what happens that if you borrow in future after 3 months and the interest rate goes up, you will be paying more interest, and you don't know, and it's not in your control that what will happen in the future. So in this case, the cash flow is unexpected in the future. Now what is hedging? Hedging is making that cash flow smoother, mitigating that risk of fluctuating cash flow, and making it certain that the cash flow gets certain and fixed that will occur in the future. So if by using a strategy or a method, you can fix the cash flow that will occur in the future, that fixation of cash flow will make you avoid the risk of loss. But even then, at that time, you may not be able to earn profits as well. So these strategies are basically known as hedging strategies. So now we'll be learning about hedging strategies. So let me define the hedging first. So hedging is a means to mitigate risk of loss by using a method that helps in fixing the future cash flow that could have been different in absence of hedging. So this is the definition of hedging, that it makes you fix, it helps you in fixing the future cash flows, and therefore you're not exposed to the fluctuating cash flows in the future. So one of the ways is forward contract and foreign currency hedges. So let's do this question. Please go through this question, Nedwin. Now maybe you have done this question in past, but just we are basically learning the approach how we are going to solve it, and in order to do that we need to learn some rules out. So I'll be giving you some rules as well. Okay, I'll be doing part B first, and we'll discuss part A tomorrow, so that we at least go through with the forward contract and the money market hedge today. And then tomorrow we'll be doing with purchasing power parity and interest rate parities and other things. Okay, so in this question, risk management will usually be asked in section A and B. Okay. So the first requirement we are doing is calculate the expected sterling receipts in 1 month and in 3 months time using the forward market. So forward, what do we mean by forward market? That we go to the bank and we ask the bank to agree a rate that at which the bank will exchange the foreign currency in future at a future date. Like the spot rate over here is 7.820, right? But the 1 month forward rate is 1.7829. So this is different. So they have quoted you a 1 month forward rate. So you can agree at this rate if you are receiving or paying foreign currency rate. So if you fix the rate in advance, then whatever be the spot rate at that time, you are not exposed to it. So this fixes your cash flow. So this is a hedging item. Then 3 months forward rate. So you have an option to fix a rate 3 months ahead as well. Now, how the rate is given? So rate has been given 1.7820 plus minus, means the foreign exchange dealer is basically doing a business and he wants to earn profits. So he will be buying the currency at a lower rate from you and he will sell to other customers at a higher rate. And the difference between the lower and the higher rate is his profits. Like we buy stocks at a cheaper rate and sell it at a higher rate by adding profit. Likewise, these people are selling the currency. Now, note one thing, that these people sell local currency. How local currency? Of what is the spot rate, if you see, is for what? Is for sterling, which is their local currency. So usually you will find that these money exchangers sell local currency. in the market. They sell local currency, and this is the foreign currency, dollar. So if in the denominator, this can be read like this, dollar per sterling. So dollar per sterling, in denominator you are getting sterling, which is their local currency. This is a UK based company. So in that case, these people are selling, these are rates of local currency. So they will always sell at a higher rate and buy at a lower rate. Means the spot rate is 1.7818. Deduct 0.0002 from 1.7820, and then one time add it, 1.7820 plus 1.7822. Now which rate is higher? This is higher, this is their selling rate, and this is lower, this is their buying rate. The lower rate will be the buying rate. So at this rate they will buy the local currency, and at this rate they will sell the local currency. This is higher, and they will make profits in it. Now let me give you some rules. Please write it down. Just for your convenience, I am giving the rules, and then I will solve on the basis of these rules. Something about currency dealers. Now these are some important rules which one should remember. You would have learned some rules, but just to revise, currency dealers, what they do, are engaged in buying and selling local currency. LC stands for local currency. They earn profit by selling at a higher price and buying at a lower price. Okay, now the next concept, rule for converting the foreign currency into local currency. So before I go on to the rule, let me start doing this question. Then I'll tell you the rule. What happens over here, that they are buying a forward contract, right? So which rate will we use, the higher rate or the lower rate? Which rate you will use? Now remember, you are buying the currency. What you are going to do in the future? In the future, you are going to receive the foreign currency, right? There are foreign currency receipts which you need to hedge. Okay, so it is a foreign currency receipts that you are going to hedge in 1 month's time. Let me highlight the things. See, in 1 month's time, there is an expected receipt of 240,000, and there is an expected payment as well. So before you hedge, always remember, if you have a receipt and payment at the same time, you will not hedge them separately. You will first net them off, because otherwise you will incur more exchange cost. You will go 2 times to the foreign currency dealer, one for the receipt and one for the foreign currency payment. So it will increase your exchange expenses, foreign currency conversion expenses. So always, you know that they are going to be received and paid at the same time, first net them off. So first step is netting the receipts and payments that occur on the same date. So we are talking about 1 month. First, netting. Take receipts. Receipts in foreign currency, which is in dollars. This is 240,000. Deduct the payments out of it, which is 140,000. So now you are left with 100,000, which you need to hedge. Now 140,000 can be obviously paid out of 240,000. So you remain with 100,000 after 1 month time, which you need to hedge. So 100,000 is exposed to change in the foreign currency rate. Now, once you are going to receive dollars in 1 month time. What you will do? You will take those dollars to the foreign currency dealer, right? So when you take those dollars to the foreign currency dealer, he will give you the local currency, right? So he is giving you local currency from his counter, means he is selling you the local currency. So the higher rate will be used. Use higher rate forward contract rate when you are expecting receipts in foreign currency. So always use a higher rate because they will give you the selling rate. The selling rate will be higher. So what is the forward rate? Obviously, remember that you are going to use do not use the spot rate, use the forward contract rate, the higher forward contract rate, because we are hedging it by at the forward rate. So your sterling receipts in 1 month time will be 100,000 divided by 1.7832. Now, how did you get 1.7832? This is how you get it, that you will take the rate 1 month forward, 1.7829, add 0.0003 to it. So this will be this will become your higher rate when you add 0.003, the margin to it. So this gives you the sterling receipts, which will be 56,079 sterling. So that's the answer to your 1 month part. Now, transaction in 3 months time. If the transaction here receipts will occur in 3 months time, then what? So again, you will use the higher rate because you are receiving money. So use the higher forward contract rate So in this case, we will use a 3-month forward rate. So the 3-month forward rate will be 1.7846 plus 0.0004, and this makes 1.7850. This is the higher rate in 3 months time, the forward rate. So the sterling receipts in 3 months time will become, now this is fixed. Now as you've agreed the rate, you now know that you are going to receive exactly this much amount in 3 months time. So sterling receipts in 3 months time is going to be $300,000 divided by 1.7850. Now this gives you the sterling amount, which is in local currency. So you are sure now that how much you are going to receive in 3 months time, which is 168,067 sterling. Okay, so this was the forward contract. Now moving on to the money market hedge. So how do the money market hedge works now? Let's talk about the money market hedge. Okay, correct, Idrissa. Okay, now let me give you the rule as well regarding the conversion of foreign currency. First, make sure that you calculate net of the receipts and payments in foreign currency, in same foreign currency, occurring at same time, and then divide the foreign currency amount with higher exchange rate when currency is being sold. So in this case, you sold the foreign currency. Obviously if you talk about the local currencies, so you place the foreign currency to the, you are going to place the foreign currency to the money exchanger, and he will be giving you the local currency. So he will be dispatching the local currency from his counter. So he'll be selling the local currency. So it will be selling at a higher rate. Is being sold. That is in case when foreign currency is received. So whenever foreign currency is received, divide the foreign currency with the higher rate. But if the foreign currency is to be paid, then what? Then you will divide with the lower rate. Why? Because you will place the local currency on the foreign exchanger's counter, right? And he will be receiving local currency from you, means he will be buying local currency from you and giving you the foreign currency. So he will be receiving foreign currency, means he will be buying the foreign currency. So he will do that at the lower rate. So divide the foreign currency amount with the lower rate of exchange when the currency is being purchased. So the local currency we're talking about, that is in case when foreign currency amount is to be paid. So this is the rule which you need to remember. So this will help you remember. This note will help you remember what to do in future. Okay, now the money market hedge. Now what happens in the money market hedge? How will we make the money market hedge? So let me explain you first that what is a money market hedge. Money market hedge means that fixing the future foreign currency receipt or payment conversion into local currency through borrowing and lending and investing or lending. So for investing, I'm using the word lending. So in the money market, funds are being sold. Some people will be buying the funds and some people will be selling the funds. And remember, in the money market, you will be able to buy local currency as well. Means you can borrow local currency, you can borrow foreign currency as well. And also you can lend local and foreign currency in the money market, right? So by buying and by borrowing and lending of foreign currency, if you fix the future local currency amount after converting the foreign currency amount into local currency, means you have reduced your risk of the change in cash flow in the local currency. So the effect of change in the spot rates is mitigated. If the payment overcome the receipts in the netting process, then you will be hedging the payment. You will be using the buying rate instead of the selling rate. You'll be using the forward contract, but using the buying rate instead of the selling rate, the lower rate, right? So the money market hedge, let's do the money market hedge for receipts. So there are two strategies, one strategy for the receipts and one for the payments. So right now we are going for the receipts, strategy for the receipts. What you will do for receipts? See, remember, this is a tip for using the money market hedge. When you are expecting to receive foreign currency in the future, like in 1 month's time or 3 months time, over here they want you to hedge the 3 months receipts using the money market. So if you are going to receive foreign currency in 3 months time, the tip is that obtain foreign currency now. Now obviously the customer won't pay you 3 months before. You are expecting after 3 months time. So the tip is that borrow foreign currency now. Obtain the foreign currency now. So how can you obtain the foreign currency now? So borrow foreign currency now so that you get the foreign currency today at the time of selling the product rather than receiving money, right? So the first point is, the first part of the strategy is, think that if you are receiving money in 3 months time in foreign currency, then what you should do now to fix your cash flows? Buy foreign currency or obtain foreign currency now through borrowing in the money market. In money market, obviously you will be working through borrowing and lending of the foreign currency. So what you are going to do, the first step is borrow foreign currency now or borrow dollars now. Now, how many dollars will you borrow? That's an important thing, very important thing. The amount of dollars that you will borrow will not be equal to the amount that you will receive. You will borrow the present value of those receipts, those foreign currency receipts. So first step is calculate the present value. Means foreign currency receipts will be divided by 1 plus RB. R stands for the rate and B for the borrowing rate, right? So RB means borrowing rate. Now, why borrowing rate has been used to calculate present value? Because you are borrowing, right? So that's why I've used the borrowing rate. So now let me make it clear that this working is for calculating present value of foreign currency receipts. Now, what do RB stand for? RB stands for the borrowing interest rate. Acha, further, interest rates that will be given in the question can be in local currency and foreign currency both. So what rate you will be using? Borrowing interest rate in foreign currency as you are borrowing foreign currency. So you'll be using a foreign currency. Secondly, the rates will be given per annum, but you are going to take rate for 3 months time. Use a 3-month rate. Because you are not borrowing for 1 year, you are borrowing for just 3 months. So you will be taking a 3-month rate. So what will you be doing? First of all, the currency you are borrowing is in dollars, right? So check the rate. What's the borrowing rate in dollars? Pick that rate first. So the borrowing rate in dollars is 5.4%. That's the rate. .4% is the dollar interest rate, and it's a borrowing rate, right? So if you are borrowing, use the borrowing rate. And for how many months? This 5.4% is for a full year. You have to make it and bring it down to 3 months. Okay. So the RB is equal to 0.054 multiplied by 3 divided by 12. So we have made it a 3-month rate, and then 1 plus RB will become 1.0135. This makes a 1 plus RB. So if you put in there, so the foreign currency receipts were 300,000 in 3 months time. Divide this by 1.0135. So this gives you the present value of the foreign currency receipts. So the present value of foreign currency receipts is 2,96,004. So this is the dollar amount that you will borrow, not 3 lakhs. Always present value. Now, why present value? I'll let you know in the end. Now, this was the first step, right? This is the first step done. I'm taking the first step in yellow. Then once you get the dollars, $296,000 borrowed, sell them now in the spot market. Sell them in the spot market. So once you sell them in the spot market, go to the spot market and give it to the foreign currency dealer and convert it in local currency. So the next step will be converting now. By converting it into local currency right now, the exposure finishes because you get the local currency amount immediately 3 months ago, you get it, right? And convert it at the spot rate, right? We are not exposed to the 3-month spot rate which will occur at the time of the payment by the customer. So convert. Now what happens further? This is not the answer, this is the second step. The answer will come in the third step. So this is a 3-step strategy, right? For payment also and for receipt also. This is the strategy for receipts, right? Afterwards, I'll tell in the next question, I'll tell you the strategy for the payments. First, you learn this strategy for the receipt. Okay. Now convert. I'll take around 5 to 7 minutes extra after the time to complete this question, and then we'll continue tomorrow with fresh minds. Okay, so convert the foreign currency amount into the local currency at spot rate. So whatever is the spot rate in the market, at that rate converted into the local currency. Now remember what rate to use. What rate to use? You have received the money, use the higher rate. You will be using the higher rate over here also. As you have received the money in foreign currency, you will take there to the money exchanger, and he will be giving you, he will be issuing you, he will be selling you the local currency. So he's selling local currency. Keep in mind. So over here, 296,004, the amount at which we arrived in the first block, divided by the spot rate, which is the higher rate. So do not use the forward rate. Remember, use the spot rate. We are not using the forward contract anymore. It was in the previous part that we were using the forward contract. Okay, dividing it by 1.7822. Now, how did we arrive at 1.7822? I used this rate, 1.7820, and added 0.0002 to get the selling rate, the higher rate. So if you receive foreign currency amount, use the higher rate. Okay. So this gives you 1,66,089 sterling now. Now you got the sterling amount, the local currency amount have been received. Now remember that you borrowed in foreign currency. So after 3 months time, you have to pay interest on it. So you are getting a cost. So in order to save that cost, invest this sterling into an investment account, lend it to someone and earn interest on it, right? And receive in 3 months time, receive a local currency amount, because this is local currency. Invest it for 3 months time and receive along with interest some more amount. So you will earn interest on this investment, and that borrowed for a foreign currency, on that you will have to pay the interest, and it will make 300,000 in 3 months time, right? So after converting, the next step is invest the local currency amount. Now remember the strategy, you have to learn it, and receive. So if you do at least 2 questions, one more like this, which we'll be doing in the next class, so you will easily learn this. Just follow the strategy which I am telling you. Invest the local currency amount and receive local currency interest and principal in 3 months time. So in this case, the formula is amount in local currency multiplied by, find the terminal value, the amount with compound interest. So this will become 1 plus RL by RL. R stands for the interest rate and L for the lending rate or the investment rate. That's why I have taken L. So when I was borrowing, I was taking the borrowing rate, and over here I am taking the lending rate. Further, what local currency lending rate or foreign currency? Simple. If you are borrowing local currency, use the local currency borrowing rate. If you are lending foreign currency, use the foreign currency. But over here we are lending local currency, so you will be using a local currency lending rate or investment rate, right? So you will be using a sterling local currency lending rate. So now see how the steps work. First we calculate, see the arrows. First we calculated this amount 296,004. Then I bought it here. Then I converted it into local currency. And then this local currency second step amount came over here, will come over here. The amount in local currency, which is 166,089. Now multiply this by RL, 1 plus RL. So what is RL? So for RL, the rate, lending rate, you will take in sterling local currency lending rate, which is 4.6%. Now again, multiply it with 3 and divide by 12 so that you get a 3-month rate. This is very important. And then 1 plus RL. 1 plus RL will become 1.0115. So multiply this amount 166,089 by 1.0115. This will increase. This will increase the amount to 167,999. And this is your answer to the question. So this amount in red is the local currency amount that you will receive in 3 months time, which is fixed, and it is hedged. So they will ask you for this amount. Remember, this amount was asked from you in the question, right? So this local currency amount will be received and in 3 months time, reducing the exposure to the changing spot rate. So now you know in advance that what you are going to receive in 3 months time. Now what happens that the invested amount along with interest is received, but the borrowed amount, what happens to the borrowed amount? The borrowed amount will be repaid. The borrowed foreign currency amount $296, this was dollar amount, 004 will become $300,000 along with interest, because we calculate present value. So when we'll add back the interest for 3 months, so it will become 300,000, become 300,000 in 3 months time. And the expected or the foreign currency receipt from customer will be used to repay it. So it will become 3 months time with interest. right? And you will pay it using the foreign currency amount, so no effect. So on the one hand, you will be paying the foreign currency amount using that 3 lakh, and you will be receiving the local currency amount 167,999. So that's your answer, which appears in red and green shade. So that's the strategy for your money market hedge for receipts. Now, is it clear? The money market hedge clear to you, or all of you? For receipts, now I'll be setting the strategy for payments tomorrow when we do the question mallet, and one more question we are going to do. So in that question, there I think there is payment amount as well. Mallet I think is against receipt, and then there is a payment. So some further risk management aspects will be done tomorrow in the next class. Tomorrow will be the last session. I will be doing some business valuation and some theoretical parts as well. So tomorrow mostly we are doing the scenario based questions with these objective type questions. Okay, and this day 3 workings will be given to you most probably tomorrow morning, as every day you are getting a worksheet. Yeah, I've already given you the answers. I've already given you the working capital answers in that the workings that I gave you today morning. So financing answers you will get by tomorrow morning. Okay. Yes, part 1. Let me discuss part 1 as well in a minute. They are asking about transaction risk, translation risk, and economic risk. Let me explain. What is the translation risk? Translation risk means when we are preparing financial statements in dollars, but there is a transaction in sterling. So you have to convert the sterling amount into dollars. And in that case, obviously, the local currency amount will change. So a gain or loss will have to be reported in the financial statement. That's a translation risk. Translation, just the risk to make the financial statement, and actually that risk won't occur. That risk won't occur in actual, because afterwards, when the financials are published, the transaction will occur at that time in 2 or 3 months time. At that time, the rate again may get same, and you may not face the loss or gain. So it's just a translation risk for accounting purpose. Then what is the transaction risk? Transaction risk means which we are calculating over here, for which we are frightened over here. We are frightened of a change in the spot rate in the future. So if in actual the spot rate either strengthens or weakens, our currency amount, our cash flow amount will change. So that change in cash flow amount will either result in a larger payment, means loss, or a reduced receipt in local currency, means a loss. So this loss is a transaction risk, that we will either receive less or will be paying less. This is a transaction risk. And what's the economic risk? Economic risk means that if we have started future projects, the change in spot rates will increase our future cost. So it's a long-term foreign currency loss. Suppose I'm making a factory in UK. So in case the sterling goes high and it strengthens, so my cost of making that factory, obviously I'll be paying in rupees. So over there I will have to buy sterling in future. So in future, if the sterling strengthens, I'll have to use more of my rupees and buy sterling in the future. And due to that, I'll have to pay a higher factory cost, incur a higher factory cost. But remember, in economic risk, I have not yet committed to the payments. I have not purchased the bricks and steel right now. But in transaction risk, I have already entered into a sale or purchase transaction. So I'm bound to make a payment on which I will be incurring a loss. So difference between transaction risk and economic risk is that in economic risk, I'm not yet bound to make payments specifically to parties. But in transaction risk, I am bound to pay right now, like in these cases, in case of Nedwin. Right, so that's the difference. And translation risk is not a loss, because it's just a gain or loss arising on translation for making financial statements. Okay, so that's all for today. Thank you very much, participants. I hope you have enjoyed today's session and you have learned a lot from the working capital. We have learned a lot of regarding the cost of equity, the specific rate and all, and CAPM and dividend growth model and the IRRs, and we have learned about especially the money market hedge is a tough one. So I hope you have got it. Thank you very much for attending the session, practice to pass session offered by ACCA. We thank a lot to ACCA. This is a great work by them. This is a great opportunity given by them. Thank you ACCA for giving us the opportunity to be in this session. Thank you. See you tomorrow with again, and I hope we manage to complete tomorrow. We will manage, inshallah. See you. Welcome all of you. Okay, welcome Deepa, Vivek, Obrain, Sabah, Said, Bukinia, and Pavishne. And Mohammad Iftikhar. Okay, my pleasure, Arslan.